Lesson 10. Equity. This is the third and final component in any balance sheet. So let's understand this. What is equity? If you subtract the value of liabilities from the total assets in any balance sheet, what is left over is called equity. Equity has two major components. One is the money that is invested in the business, and two, the profits that are made out of the money that is invested in the business minus the dividends that are paid to the owners. Let us understand this. Equity belongs to the owners of the business. Individuals or institutions can provide capital to a business by owning a share or a stock in a company. In return, they're issued something called as the stock certificate. In return to the money investors, the stockholders or the shareholders get a share of profit. This share is called dividends. The owners also benefit by way of appreciation in the stock price by holding the stock over the period of time. Let's look at an example. Assume that John buys shares of Apple Inc. at $120 per share in 2015. He gets dividends at $15 per share in 2016 and $20 per share in 2017. And in 2018, he sells his stock for $180 per share. So in 2018, John wants to know how much money he's made by holding the shares of Apple Inc. There are two types of returns that he's got. The first one is the dividends that he's got for 16 and 17, which is $15 per share and $20 per share, totaling to $35 per share. The second one is the appreciation that has happened in the stock price. He bought them as $120 per share and he sold them as $180 per share, therefore making a gain of $60 per share. So the total return on this stock is the dividends that he's made plus the capital appreciation or the growth that he's made by holding the shares. So the shareholders own the business and not the CEO or the board of directors. Shareholders' expectations therefore have to be treated with utmost respect. If the performance of the business does not meet the shareholders, the board may be dismissed, investors may sell their shares, leading to a fall in share prices. There are a few common misconceptions when it comes to equity. The most common misconception is that if the company's share price rises, it has more money, and if it falls, it has less. Let me give you an example. Let's assume that James invests $1,000 in the shares of a new business. In return for the money, he gets a share certificate or a stock certificate, which is a piece of paper. Let's assume that Robert offers to buy the shares for $1,200 after some time. And James hands over this piece of paper called the stock certificate, and he makes $1,200 cash from selling these shares to Robert. Note that Robert hands over the shares to James and not to the company, and therefore James has made the profit of $200 and not the company. So the company has got nothing to do with the rise or fall in share prices directly, meaning it does not get affected by the money that the company has. Summary. Equity is the excess of assets over liabilities, and equity holders get return in two forms: dividends, which is your share of profit, and growth, which is the capital appreciation over a period of time. When one shareholder sells his stock in a stock market, the company's money does not get affected.